Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, June 3rd, 5:04 p.m. Eastern Time, coming to you from San Augustine Beach, Florida, with the big show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important to know for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market, we're in a short-term uptrend. We have been since May 26th when we had a follow-through day. That is a display of strength in the indexes, accompanied with some positive action in leading stocks. Ever since then, progress has been slow, but we're not giving it up. Still holding above a key area you can see over here on the trend gauge. As far as leadership is concerned, leading stocks, we're neutral with the sub arrow pointing toward bullish. We've seen, I had a list of 24 stocks actually on the 21 over 21 list going into this week, and some weakness in a particular sector that we'll take a look at shortly stood out. But 20 of the 24 held and are carrying over to this week, so that's a good sign. From a trend standpoint, short term, all 5 of the major indexes that we track are above their 21-day exponential moving average, so we're in an uptrend, a bullish uptrend there. Medium term, we're coming into very soon, probably next week, unless we break down, coming into the downtrending medium-term 50-day moving average. That's going to be a very key test of the market strength. And long term, we're below the critical 200-day moving average. This is when risk is elevated, and we don't play around in this situation. This is when severe sell-offs can occur. We approached a 30% downtrend on the Nasdaq. We touched 20% on the S&P, and we then bounced up to about a 12% loss. Gave a little bit of that back today. We're going to look at all this on the charts very shortly. But under the 200-day moving average, you know that is when we play maximum defense and only get involved in the best risk-reward situations. So what happened today? Extreme weakness in the NASDAQ 100. That's tech stocks, primarily driven by Apple and by Tesla. There was a report out early this morning that Elon Musk has a bad feeling about the economy and wants to lay off about 10% of the Tesla workforce. So on the day, Tesla was down 9%, Apple down 4%, as Europe wants their pound of flesh. They want to increase taxes on Apple. Apple, as I said, another weekday today. So between those two, NASDAQ 100 doesn't really have a chance. And then pile on Facebook down 4%, Google and Amazon each down 2.5%, NVIDIA down 4.5%. Not a chance for the NASDAQ 100 today, giving back most of its very strong gains from yesterday. If there's any positive to take away, it was an inside day, meaning we held the lows of the prior day and below the highs of the day. So a little bit of a consolidation day, but pretty negative from a consolidation inside day. Good signs, we're still holding on by the skin of its teeth, especially on the NASDAQ 100, but we still are holding on above the short-term 21-day exponential moving average. So that's the positive takeaway. The numbers on the day: G6, our growth proxy, down 1.6%, S&P down 1.6%, NASDAQ 100 down 2.6%. Dow down 1.1%, mid caps down 1.1%, Russell 2000 small caps down 0.8%. Diversified global 60/40 stock bond index down 1.1%. In-house down approximately 0.31%. Holding on to 2/3 of yesterday's gains, unlike the indexes, which gave back about 80% of their gains. So a decent week for us, about flat for the week, while the S&P was down over 1%. We'll go to the tail of the tape and charts shortly, but first let's take a look at the team here at Revere. Some people derisively call what we do market timing. We call it trend following. Participate in the market when it's in an uptrend, tighten up a little bit, pull back when we're in a sideways consolidation, and get the heck out of the way when we're in a bear market downtrend. And if you like this common sense approach, we'd be glad to explain more to you, explain why Wall Street is rife with conflicts. From what they tell you, you got to stay all in the market all the time. Give us a shout. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Now to the charts. Here's the S&P 500. First of all, let's blow this up a little bit, and you can see clearly in a downtrend as we topped right at the beginning of the year. We're in the third rally that we've attempted since this downtrend has begun, and we're above the green line. That's the 21-day exponential moving average. As long as we stay above there, everything's fine. But the more times that you knock on a support, the weaker it gets. It's kind of like chopping a tree down. So this 4070 to 4100 area is a huge support area that we need to hold. If that breaks, our outlook on the market is going to break. We're going to get very defensive very quickly. Another option for us getting more defensive is if we continue up higher and meet up with this downtrending 50-day moving average. We don't predict, but we have expectations. The expectation would be that we would fail around that area, because that area also coincides with this 4,200 level on the S&P, which has been a big support / resistance area. Once you break through support, it becomes resistance when you try to get back up through it. We broke down through this the beginning of May, went much lower from 4,200 down to 3,810, and now we're in the process of bouncing. How far the bounce goes, we don't ever know for sure, but we know key levels and when it's likely that they're going to fail. Our current plan is to lighten up around this 4,200 area should we get there. We would also lighten up if we broke through this 4,000 area, which we've tested multiple times over the past 6 trading sessions, and really need to hold on to. So those are the key takeaways for next week: 4,200 on the upside, 4,100 on the downside. So we're trapped in this 100-point range. We have been for 6 sessions, and just kind of playing ping pong back and forth between the highs and the lows. NASDAQ 100, let's take a look at this. Certainly weak, as I said, gave up most of yesterday's gains, down 2.6%. Again, look at this green line, the 21-day moving average. It's held any downtrend for the last 6 days, 5 trading sessions, because we've had Memorial Day mixed in there. We break through that, that's going to drag on the overall market because of how tech heavy the S&P 500 is. And again, we're going to get extremely defensive if we break through this area and don't quickly reclaim it. Let's look at the Dow Jones Industrial Average. Relative strength today, bounced off the 21 2 days ago. So again, there's that key theme, the 21-day, tight inside day today, relative strength day today. This looks fine, but again, this key area, Thursday's lows are key across all the indexes. Thursday's low is 32,509 there, so that's the key level that we're looking for next week to hold on the Dow Jones Industrial Average. On the upside, we don't seem to be able to get back above 33,250, so that's the level that we're looking for. All these index charts pretty much set up the same, and you can see this declining red line here. We're coming up into it. Right now, that's about at the 33,500 level. Let's go to mid caps. These have been showing some strength lately. You can see we ran into this failure on the mid caps yesterday, into the declining red line, the 50-day moving average. That's what we're expecting to see when we finally do test it with the large cap indexes, the Dow, the NASDAQ 100, and the S&P 500. This is very much what we're expecting to see. Notice the tight inside day for mid cap. So we're stuck between the downtrending 50-day, the red line, the uptrending green line, the 21-day. One of those is going to win this battle. We've got a close eye peeled, and we've got plans for both scenarios, whatever the outcome is. You could also see a fake break up above or a fake break down below. and again, we're prepared for that also. Small caps, you can see again, trapped just like mid caps between the uptrending 21-day short term and the declining 50-day intermediate term. The rubber's going to meet the road next week on that either way. Next week will be a very key area for all the indexes. And of course, because 75% of stocks track the overall index, it's going to carry over to individual stocks. The only stocks that seem to be avoiding the trend very clearly are oil stocks. And 2 of the 5 stocks that we own are oil stocks. That's the spot for relative strength that we've been seeing. So there's our review of the indexes. Next up, I want to take a look at the tail of the tape here and go through this. We went through the indexes. Short-term uptrend, sentiment doesn't jump out one way or the other, kind of on the neutral side. We're still operating under this bull case since we got back above the 21, but that's the key area that we need to hold. I mentioned on the news, Elon saying Tesla may have to lay off 10%. Also, we had a strong jobs report this morning, which is counterintuitively actually weak because the job market remains strong. That's less of an incentive for the Fed to continue to raise, to stop raising interest rates. So unfortunately, the consumer's going to have to feel some pain before we come out the other end of this, with the headwinds continuing to be the strong dollar, inflation, the Fed tapering and they're reducing the balance sheet, rising interest rates, and Russia, Ukraine. A lot going on, but we're not going to be making decisions based on the headlines. If we did, we'd never get back into the market until all these things resolve. The market always climbs a wall of worry, but as I mentioned, we've got plans for the bear case and the bull case. So what we were watching coming in today are these 2 levels: the support level at 4075 to 4100, the resistance level at 4160 to 4200. We didn't test resistance because of the gap down and the continued lower, but again, we did hold on the downside this 4075 to 4100, and that's really what has to hold for next week. I noted, you can see here in the notes, the negative takeaway from today's action. Apple and Tesla breaking below their 21E. NASDAQ 100 still barely holding on to it. Oils continue to be very strong. Biotech was also strong today, and defensive stocks like Northrop Grumman strong today. On the other hand, on the weakness, 10 out of 11 sectors were down. Only oil was positive. Tech sectors weak across the board. Airlines weak. Gold and silver stocks were weak, and XME base metal stocks were weak also. So portfolio changes. We added to our Chevron position. That had a very nice day today. We started it yesterday with a 2% size. When we see continued strength in it, we add to it, so we're up to 4% size in Chevron. We also added to SSO. This is our leveraged S&P 500 product, and initially during the day, when we tested and held this 4130-ish area, we got down to 2117 and bounced. We added to it there. Then we had a break below that, a reclaim it. Got back to even on it, but then a little bit of a fade into the close. So we're down just a tiny bit, about 1% on that additional position, but into the close to reduce risk because that didn't hold. We sold our QQQ position just to reduce risk. So you can see overall our volatility adjusted beta is 0.85%. We're holding 4% positions in ON. This is the strongest semiconductor stock that's out there, also in the 21 over 21 list. Really nice inside day for it, finishing at the top of its range after the breakout above this 60-61 level yesterday. One of the best looking stocks in the market, and as you can see, relative strength at a new high. Look how relative strength is at a new high while the stock itself is still over 10% away from a new high. This is how we identify the strongest stocks in the market, is by this relative strength line relative to how they're acting versus their price. We don't need price to be at a new high if relative strength is at a new high while the market is still in the process of correcting. This relative strength line is what leads us to the strongest stocks in the strongest sectors. LNTH, also a 4% size. We own that. Lantheus Holdings, a medical product stock, continues to ride higher above the 21 and the 8-day moving average. We're up about 6% on this position. Zim, this is a shipper. We got a 4% dividend coming our way next Wednesday on this, and this is forming a very nice cup-shaped base. We're positive on this position when you factor in the dividend, just about break even without it, but setting up very nice for higher prices. And then I mentioned CVX we also own LNG, an oil and gas transportation pipeline stock. Nice action, nice relative strength on this over the last couple of days as it came up through its moving averages. So those are the 5 positions that we own: 2 oil stocks, 1 shipping stock, 1 medical product stock, and 1 semiconductor stock. Additionally, we own GLD. This is gold. This has been consolidating above the 200-day moving average. I think we're about flat on this position. TBT, this is the inverse. This is a bet on higher interest rates and a bet against bond prices. This goes up when interest rates go up and when bond prices go down. As long as we're above this green 21-day moving average, we're going to stick with this position. And then we also have index positions in the Dow Jones Industrial Average, which will hold as long as it's above the 21, and also with the SSO, which is the S&P 500, which will also hold as long as we stay above the 21, although we may do offensive selling when we run into the declining 50-day moving average when that comes, provided we don't break down first. So those are our positions that we hold in-house, what we're looking for. These key levels, as I continue to mention, you can pause it here and absorb all of these different levels that I'm talking about, but the key one is to the upside, 4160 to 4200. We want to get through that. That'll be very bullish. On the downside, 4075 to 4100 continues to provide support over the last 4 trading sessions and even going back to the prior week, but it's critical that we hold that area on the downside, or we'll be getting quite a bit more defensive. So let's move on to the 21 over 21 leaders list. And first I want to talk about something in common with 3 of the 4 stocks that we had to cut this week. First of all, DAL cut. This is not related to the other theme, but tried to break it above its moving averages. Airlines look strong late last week and early this week, but they just gave it up over the past 3 days. So our small position in Delta Airlines was stopped for a small loss. And then the theme is weakness. Let's show XLV here first. This is the medical sector. Look at the declining relative strength on this over the last week and a half. Money has been, for whatever reason, I know Washington's talking about trying to cap drug prices. That could have something to do with it. But 3 medical stocks that were in the 21 over 21 list are now gone because they broke their key short-term moving average. First one being Merck. You can see the extreme lack of relative strength or relative weakness in Merck over the last 2 weeks. MCK. This is McKesson. They're a drug wholesale supplier. Another lack of relative strength over the last week and a half, breaking below the 21. And finally, Eli Lilly, which tried to break out of a late stage base last week. This is a stage 3 base. When we get up that high in the base count, they're more risky. Failed breakout, 4 straight down days with some selling and breaking below the 21. It really doesn't look like a bad pattern, but a failed breakout is very clearly a red flag. That meant that institutions were selling the breakout and moving their money into somewhere else. So 3 medical stocks out of 4 taken off of the list. The new addition to the list, there was one to get us to the 21 level. That was Enphase, a solar stock. Enphase and Sedge both forming nice bases. A lot of relative strength in solar stocks over the last 2-3 weeks. So that's the new addition. Now the 20 carryovers from last week. First one is Zoom. I'm going to go. This is tight to see. and I explained this last week. I know it's below the 200-day moving average, but let's go to a 60-minute chart on this, and you can see how Zoom has been showing extreme relative strength since its earnings report. That, coupled by the fact that it's gotten down to a PE of 23, certainly more reasonable than when it was trading up at 404. This is trying to form a base. Some of these stocks come back, some of them don't. Zoom was one of the ones that was just caught up in 2020, 2021 in the high flying growth stock before giving back 75% gave back 75% off the highs, but now forming a base. We're keeping a close eye on this because this is a proxy for some other software stocks. They're not all going to go to zero. Some of them are holding up. This is one of the best ones. That's why it's in the list, despite the fact that it's below the 200-day moving average. But it's 40% below the 200-day, so that won't even provide resistance until this thing runs for quite a while up to it. First things first, it needs to get back above this 110 level. Let's continue on. T-Mobile acting just showing relative strength. Much better growth numbers relative to AT&T, but an extreme relative strength going back to the end of March. This is just forming a very nice long cup with handle base. Nothing spectacular about it, but they are still growing relative to Verizon and AT&T. M&T Bank, best looking bank chart that you'll see, continues to trend above the 21. Albemarle, brutal 2-day sell-off in this on a Goldman Sachs report about declining lithium prices, but it bounced right where it needed to at this key 21-day moving average and still looking very good with good growth numbers. Ulta Beauty gapped up on its earnings, giving it back on lighter volume relative to the gap up, holding above this 400 area. Let's see if this is it's putting in a handle. Let's see if volume can dry up now and spark it to higher prices. WDC, Western Digital, computer data storage, forming a little bit of a base here since it gapped up on its earnings report, showing relative strength as it holds above the 21 and holds this 60 level. ON Semiconductor, as I said, we own this, one of my favorite charts. As long as it continues to act well, we're going to ride it higher. And this thing is popping after hours, up by about 7%. Looks like somebody took a big stake in it. There was a form that was filed, and it is trading up to near 68. No, wait a minute. It's closed at 63. It's trading near 67 after hours. So good for us, and good for ON. AT&T, second telecom stock that's in here, putting in a little bit of a handle, showing relative strength, as that's just a place with a big dividend for scared managers to park money. AMCR, containers and packages, nothing earth-shattering about it, but again, another place with a low PE stock of 17, another place to park money. Zim, we own this, as I mentioned, forming a very nice pattern. LTHM, barely holding on to the 21. I mentioned how this and Albemarle had two terrible days on that Goldman Sachs report. Got a little bit ahead of itself. There's a big need for lithium in the EV space. Let's see if this can hold on to this week's lows and the 21 as it did bounce off of the lows. CC, the Chemours company, chemical specialty, chemical basic materials. This is a place where, again, where money flows to. Lower PE stocks, you can see it's got a PE of 9 with a growth rate of 32% this year and 14% next year. When you've got a price earnings to growth ratio of below 1, it's very clear that the stock is providing a value, and value stocks are outperforming growth stocks as we correct. AMR, coal stock, choppy, but it's a choppy uptrend. ExxonMobil continues to make higher highs. Chevron, which we bought yesterday and today, still near all-time highs. Olin Corp, another chemical specialty, riding this 21-day higher. Again, a PE of 8 with a growth rate this year of 25%. Occidental Petroleum, one of the leading Oil and gas international exploring stocks looking fantastic. LNTH, another one that we own near all-time highs. Arch, another coal stock, bounced off the 50, holding the 21. Just big distribution and a special dividend on Arch this week. Coal stocks, the electricity generation that's needed has to come from the plants need either coal or nat gas to run them, and there's a shortage of both. Both are very expensive. And finally, Devon Energy has been on this list for weeks, and it continues to trend near higher highs. And that's your updated 21 over 21 leaders list. And that's going to wrap it for this week. As always, love to hear from you. Email me, don@revereasset.com, or phone 855-REAL-WEALTH. For the week ending June 3rd, this is Don Vandenbord, just the facts, telling it like it is. Thanks for listening. Have a great weekend.